Hi, what's up, guys?
And if you want to skip the riffing, you can go straight to the content at about 2 minutes and 50 seconds or thereabouts.
I decided to try the wackest hair I could possibly do, which is like, this is quarantine hair edition 1, which is my weird quarantine hairstyles. Really long on one side, messy ponytail, but hey, don't you like the asymmetry? Wearing this like safari jumper, which I love. And today I am between, oh my God, I'm gonna have to fix this. Hi. So today I'm between these beautiful, like light pink roses I found at Trader Joe's. Oh, it smells so good. They came in this little packet. I just love this color. It's not like obvious pink or hot pink, but it's like this peach almost. It's almost orange, like orange white. And yeah, I just love the variety in this. This, if you believe it, came in this pot as well. That will complement nicely with some decor. One room that I'm making more like a bronze. So it came with this, all for the fine price of $5.99. So I'm also between this zebra plant. I am so excited about this. This brings me so much joy. I'm gonna split this plant in the next video, but ooh, it's like dripping because I guess I watered it. But I'll take a top of that yellow flower that's gonna be blooming from it soon. So I'm so excited. I just love looking at this too. It's so striking and it just brings me joy. I just look at this and I'm like, yes. And every day it's like, it's almost gonna bloom. It's so fast. Just this week, making a lot of progress. This yellow bud that's forming in the middle. Today, I wanted to talk about the different types of order types and what you can glean from each one of those. So first you have market order. That means right now, whatever the bid and the ask for, price usually in the middle. Usually if it's a very liquid stock, which means there's a lot of shares floating around and it's not hard to get into and out of, unlike say something that is less openly traded, like some obscure marijuana stock that is barely made it to the NASDAQ from the pink sheets. Pink sheets meaning like over-the-counter stocks, which are just kind of ones that are starting out that don't have a lot of traction. Not traction in a sense, because you could be a privately held company and have a lot of traction, but just they're just not really on a larger exchange like the NASDAQ, the NYSE, or you know, in each country there's their own exchange, like the DAX, I think, is Germany. ASX is for Australia. So market order is immediate. They will execute it for you right then and there. This is where there's some leeway.
You know, like how Robinhood and other commission-free brokerages can actually make up for the free commissions and free trades by taking a very small cut, usually just fractions of a penny, or if it's a larger stock, pennies from that spread between the bid and the ask. This is also called selling your order flow to native exchanges that then execute client orders, also called payment for order flow, or PFOF. That's why some more professional traders pay for their own source data.
Maybe most brokers do it now because all trades are free. So they basically give you a worse price, usually probably pennies, unless it's a giant stock like in Amazon. Maybe it's like $1 or 50 cents on a volume basis. For every like 100 shares of Amazon that they ding you $1, that's $1 they have in the brokerage's pockets, and that's how they are able to give you free trades. Some of them, not all of them. Especially if you're long-term or mid-term, it doesn't really matter. Like, you could just go for it because a few cents isn't gonna make or break your trade. The way things are conducted lend themselves to being much more cost effective these days with the internet and data exchanges and data being able to be hosted fairly cheaply. So that's a market order. Second, you have a limit order. So a limit order is when you specify a specific price. Usually they'll give you a few selections. First, you of course select if you want to buy or sell, then you select the time of action or the time of execution. So that's whether it's the day only, 9:30 a.m. to 4 p.m. Eastern Standard Time. I'm on the West Coast, so I'm like calculating 3 hours. I've just been so accustomed to it. But yeah, 1 p.m. here versus 4 p.m. there. Yeah, so it's 9:30 a.m. to 4 p.m. Eastern Standard Time. So that's good for the day only. It doesn't count for after hours, which is after that. So, or extended hours. Usually extended hours consists of pre-market, which is anywhere from when your brokerage opens. And the best one for that would be Interactive Brokers. They open really early that I have seen. Whereas the other brokerages open like at 7 a.m. or whatnot. There's also TD Ameritrade, which has like round the clock trading for certain ETFs and whatnot. Or if you trade futures, like none of this is as pertinent because there's different hours or different hours when it's more active. After hours is basically any time after that 4 p.m. Eastern Standard Time, 4 p.m. to 8 p.m. Eastern Standard Time. So that's fairly standard. Almost all brokerages go until the 8 p.m. So that's a limit order. Next, you have a stop order. So a stop is when you select a price that which it goes below, it will execute. It's usually used for when you're selling something. So if you have like 50 shares of Netflix and you want to make sure that you lock it in at $5.25 or whatever it is, and if it goes below that, you just want to lock in all your profits, that's called a stop order. And there's different types of stop orders, just a regular one, so you execute an exact price. There's trailing stop. That's basically either a number, like if it falls 10 cents, I want it to execute, or a percentage, like if it falls 1%, it'll execute. Certain brokerages give you a minimum, like 1%, because they're more geared towards long term, but a lot of them are quite flexible. So this is actually pretty useful for locking in profits. I like the trail stops because you don't have to worry about it. I should put them on a lot more because it would save headaches instead of like scrambling. Then there's also stop limit. What this is trying to help you mitigate is a lot of times like there's some volatility, especially in the early like first hour of trading. There's a lot of activity, or sometimes the last hour as well. And sometimes you can have like a huge dip in the morning. They call it the morning dip, but you can just have a huge dip 10 minutes or 30 minutes in, and then it just recoups right back up and past where it was already going to head more long-term or mid-term. And so to prevent you from getting stopped out, which is when the stop order executes and you don't really want it to, because you would have lost a profit in it going up. That's what the stop limit is for. Because there's so much volatility and range in the first hour or even 15-30 minutes, they don't want you to suffer as many losses based on that. So basically when Netflix goes below $5.25, if you set that stop order, then the limit is like you want it to execute at $5.24.95. You don't want it to be like a really low number because it fell a lot. But that's what a stop limit is for, just making sure to lock it in at a certain point at times of more volatility.
So some overarching points and a recap.
And all of these can be good for the day, like I was discussing. It could be good till canceled, which is sometimes forever or sometimes 90 days or so, depending on your brokerage. They can just have a limit because they figured if in 90 days you didn't get that at the price you wanted, maybe it's just time to cancel it. Or you can cancel it yourself. That's why it's called good till canceled, which is either the limit by the brokerage or when you cancel it yourself. It could be extended hours like we were discussing. So that's either pre-market, 4 a.m. to 9:30 a.m. Eastern time, or after hours is 4 p.m. to 8 p.m. Eastern Standard Time. Some brokerages, like the ones geared more towards long-term, will just allow you to do extended hours for that specific day or so. TD Ameritrade has an extended plus day. That's just any time they will help execute that price. The extended hours, usually your price will not execute unless it's the mid price between the bid and the ask. So those are the time frames that you can select for your order types. And I believe that's mostly its limits, stops, market. When I first started, I literally had no idea. I didn't have any trading software. I was like looking at Google for like my stock price, like Tesla, when it was much cheaper than it is today. Before the split, it's insane a little bit, and it just makes me feel like in this environment I would rather have 1,000 inflated dollars than one inflated dollar. So if that is a thing, I'm still going to be invested. But I was just looking at Google and timing my market order, and I was like, what am I doing? I think this is okay. So hopefully this is a little bit of guidance for you. I just, called brokerages, like, I don't know what this is. Sometimes there's a tendency, or when I first began, there's a tendency to like watch it tick by tick a little bit, but that's not very helpful, and I don't think it's good for you psychologically. There's a bit of luck, of course, with it, so timing it to the 10 cents is not really doing you any big favors in life, unless it's like a position where you're gonna buy 100,000 of, which we probably don't want to do. I mean, unless you have super deep pockets, you usually don't want to go all in like that. The other thing is, with all these orders, if you're going short, which is when you borrow some shares from their brokerage and you buy it back at a lower price, that's how you make a profit, by betting on the price going down. These order types have a different connotation, like limit orders and market orders are what they are, right? But when you're doing stop orders, when you're shorting, then the opposite holds. Your stop is a price that you have to put a price that's higher than what it is now, because you're going in the opposite direction. So when you're betting on the price of something going down, when it goes a little higher, that's not good for you. That's, like the opposite of what you want. You want it to keep going down, right? So your stop order is going to be slightly higher than, or however much higher. It really depends on how volatile and how much range a stock has too. So there's different ways I've thought about for how to calculate that too. And I could share with you in like a more advanced series, or possibly a course. So look forward to doing that. I hope that was helpful. Of course, let me know if you have any questions and what you think, what order types you prefer. And with that, I'm out. And peace, my friends. Bye.